So there are fairly straightforward methods you can use to plan for inheritance tax. A couple of them. So the first being a potentially exempt transfer. So just making gifts to your next generation, the beneficiaries, of any amounts. As long as you survive 7 years, then those will typically be out of your estate. There are other taxes to consider as well. So making gifts of property or a share portfolio could have implications in capital gains tax. So it's looking at the potential initial tax cost versus the long-term benefit.
And I think that's for the potentially exempt gifts. I think that's often where the cash flow planning in the first instance comes in really useful, because it allows a client to quantify, well, what is my availability to provide gifts.
Absolutely. And moving on from the potential exempt transfer, the larger gifts, with the cash flow planning, it's key. You can actually make gifts out of income. So providing you can demonstrate either a regular pattern of gifts, say for school fees or even annual holidays, as long as there's a regular pattern, and you can demonstrate it doesn't impact on your lifestyle, then with the cash flow planning, that's a fantastic way to kind of mitigate inheritance tax.
And I actually read a great article by you, Amal, on gifts out of income that was actually really interesting, because I do think it's actually one of the most underutilised inheritance tax quivers in the bow of the armoury.
So we get clients to document it and provide it annually on an annual basis, their gifts out of income. It's important. And then the other point is you can also make large one-off gifts, providing there's a pattern. So it might be to help out with a loft extension, providing they're regular gifts. You may also be able to get those immediately out your estate. So it's worth looking at, and with careful planning, it's a really useful tool to get income out, or assets out your estate immediately.
You and I often have this conversation where clients come to you and they've said, well, I don't want to provide gifts, or I don't have the scope to provide gifts out of income. And they say, well, what's that one magic thing that I can do that is going to provide money set aside to pay my inheritance tax bill? Because actually that's often a concern for clients. It's not what happens when they, during their lifetime. It's, well, actually I might have, a large estate, a very large estate, and often it's liquid. So I know you deal with a lot of property investor clients, and something happens to the client, and then you have 2 years in which to pay the inheritance tax bill. One thing that we find often resonates with clients like that is insurance, where really all you're doing is saying, okay, we've helped you quantify that you have an inheritance tax liability of however much, and you can take out insurance that's going to cover that amount. So on your death, sitting nicely and structured in a very simple trust, but essentially it's there for you, it's outside your estate. So often clients say, well, actually I'd rather something that's completely outside my estate. And that's why, I think you'll remember this because you're a tax nerd like myself, but in 2015 when George Osborne stood up and he said pension freedoms for everyone, and one of the byproducts of those changes to the pension rules were actually the pension became an asset that was outside your estate. If anything that we've talked about today has resonated with you, we would be very happy to have an exploratory conversation to discuss where we can add value to your circumstances.